Our next guest says despite all the volatility, he sees good breadth in the markets and opportunities in the so-called halo trade. Here to tell us more is Damian Fernandes of TD Asset Management. It's nice to see you.
Likewise. Thanks, Kim.
I'm going to break this into two parts, maybe describe the world, and then we'll talk about the opportunities that derive out of the world that you see. But if we start with the economy right now, it's a bit jolty, lots of interesting things happening. Let's start with the States, and then we'll go to the rest of the world. What do you see in the U.S.?
Sure. I think the first thing, Kim, is that the prognostications you see on social media just aren't justified of what's actually happening in the real world. Meaning the real world is accelerating, meaning we're on the cusp of a economic cycle that is actually being driven by goods. And when you think about the factors that are impacting that, we have tax cuts that are going to stimulate consumption. We have incentives where if you actually build structures, you get to claim a whole bunch of depreciation expense, so you get more cash flow. So you're actually pulling forward demand, and you're seeing that in the numbers. You're seeing that in the economic numbers. You're seeing sentiment measures start to tick up. You're seeing activity start to move higher. All of those are supportive for growth. And it's interesting because my initial comment was don't believe what you hear on social media. There feels to be a lot of doomsdaying, but we're in the midst of Q1 reporting, and it's the fifth quarter of double-digit, close to 14-15% EPS growth. Fifth quarter. This isn't, it shouldn't be a surprise that we're growing really well and markets are flirting with all-time highs, and yet people. There's a despondence, oh my God, it's all going to collapse somehow, or AI is going to eat all our jobs, or whatever the scare. I think it's much more normal. I think we're in the cusp of an economic cycle that's accelerating, and as investors, we should be participating in that.
Let's take a look. I know you brought some interesting charts. Speaking of the economic cycle accelerating, you've got a look here at new orders and inventories. Tell me what we're looking at and why this is notable for you.
Yeah. So what you're not looking at is like when you go to the hospital and you see a thing of your heart rate, you're not looking at that. What this is, it's pretty simple. It's the ISM, so the Institute of Supply Management, purchasing managers, the people who buy raw materials. They've been serving these people for over 50 years. This is a more truncated chart going back to the 90s, and it's literally two questions. It's asking purchasing managers, the people who buy raw materials, what's your demand for new orders? What are you seeing in new orders? Less what's in your back room, what's in inventories. And if new orders are growing faster than inventories, and you see that spike more recently at the end of the chart, that's what it's saying. It's saying new orders are accelerating, growing much faster than inventories. If you're a purchasing manager and your order book, your demand is growing, but you don't have inventories, it means you have to produce.
Right.
Production is a fancy word for economic growth.
Yeah.
Right? We know that. So. Yeah. The thing is, because new orders are accelerating, that means you're actually seeing demand that's going to flow through the numbers in the next few quarters.
Let me ask you, that's U.S. In terms of thing. When you kind of branch out a little bit and think about the world, I know you've got another chart for us where we're taking a look at East Asia exports year over year. Tell me why this one catches your eye, because is it safe to say there's more activity happening in Asia than there is in North America, or not?
Well, I think it just shows the connectivity between the different, these are two large economies in Southeast Asia, like South Korea and Taiwan. They're tied to semiconductors, but when you think about what South Korea and Taiwan exports, they export memory chips and or in the case of Taiwan Semiconductor, or component parts that are used in the manufacturing process. If exports are growing 30-40%, which they are year on year, that means component parts are getting shipped, which are going to go into end products. Right? People aren't ordering these component parts because they're not seeing end demand.
They need the ingredients.
They're ingredients. So that's my thing. I think the ingredients you're seeing, acceleration of the ingredients, which means you'll see that show up in a few quarters in activity. People actually putting these ingredients together. The biggest component for the cycle, the global cycle, is if Taiwanese and South Korean and Vietnamese exports accelerating, improving, growing 20% year on year, you are going to see that show up in earnings in a few quarters, because those component parts will be finished goods and sales of some multinational company.
Yeah.
Right? Yeah. And so that's what we're seeing. We're seeing a hookup, and you can see in this case, and just from the South Korean exports, we're growing at some of the fastest paces we have been in the last 5 years. And this is after tariffs. Yeah.
Yeah, right? That's true, right? And you, and you think, I know because you were speaking with Derek, one of my producers, and you're talking about that, whether the tariffs are 15, 10, 13, they're here. and that's what people need to focus on, is that they're here for good.
Yeah, we can talk about tariffs, and I know over the weekend it's funny, like the same people that Donald Trump, who helped, actually are constitutionalists. Like, they actually believe what's the written word, and they said that IEEPA tariffs, you just can't, this isn't an emergency, but that, right
there's
after
other ways.
There's other ways, and I think the way I think about this, right, is right now tariffs for the U.S. Treasury are bringing in over $400 billion of revenue. Whether it's Democratic or Republican, it doesn't really matter. It's going to be hard to say no to that. It's not, and the world has moved. Inflation hasn't, inflation has actually come down since last year. Activity, I was just showing you, is improving. I think people are getting accustomed to tariffs, so it's hard to see a full it's going to go through the courts and stuff. But what I can say is that the measures that have been implemented now that he can use removes or increases some level of certainty. Like, you just can't arbitrarily put tariffs because someone said something, I don't know, mean or something. So that produces some certainty. The tariffs are probably likely here to stay, and we shouldn't expect any more aggravation of tariffs going forward. I think that introduces some level of certainty, which is always great for business executives. Yeah. Because they think that, hey, I have some predictability in my planning process, and so I can actually go and build that factory without thinking I'm just going to have extortive tariffs in the way.
Right. I mean, you do have some predictability. I still think there's a lot of predictability out there still. We have to kind of navigate. What about, and I said we'll get into sectors in just a minute, but when you think about the rest, like the Canadian markets, and kind of how, because, you mentioned, the Canadian markets, if you hold in Canadian currency, it's a little more palatable right now. What are your thoughts around that?
Well, I actually think that, so putting some numbers to that, right, in the Canadian market last year, U.S. equities did fine in local currency, in U.S. dollars. They were up 15. But if you're a Canadian investor, because of the Canadian dollar appreciated, you're only up about 10% last year. Whereas the Canadian market was up close to 30. Global markets, some of them, Europe, Asia, were up 20. What's actually happening, like I say this jokingly, right? Donald Trump, in Making America Great Again, has made global equities great again. Made global equities, and what's actually happened is that the motivation of tariffs have actually created incentive structures in Canada where we're now focused on pro-growth measures. Yeah. This is very positive, right? The trend growth of our economy is actually being improved because we're now talking about stimulus measures, talking about infrastructure investment, talking about reducing interprovincial trade barriers, all these things that are pro-growth. The reason the TSX is flirting with all-time highs is vis-a-vis where we were a few years ago, our trend growth has probably moved up. That's positive for a Canadian investor.
Let's bring this one up. Did you put the title on this one? I like it. We are living in a bizarre world.
I like the visuals.
Yeah. Tell me what is, just explain why this is so notable from your perspective.
Well, this is the U.S. market. The green bars are the weights of sectors in the U.S. market. Okay. What should draw your line is the left side. Right? The biggest weights are infotech. Yeah. So your Microsofts of the world, followed by comm services, your Metas and Googles.
The Mag 7s.
The Mag 7s of the world. So, those are the biggest weights in the U.S. market. The blue bars are what's interesting. Those are returns year to date. And they're negative. The Mag 7 has lagged. It's the lag 7. Whereas on the far right, the smallest weights, the smallest green bars, you have to squint to find them, are in things like energy and utilities and materials. But they've had the biggest returns year to date. It's almost like the reason the U.S. market's flattish is because the math doesn't math. Right. What I mean by that is that the biggest weights in the index are actually lagging. Yeah. And there's not enough, and the stuff that's actually moving, the S&P 493, right? Yeah. Not the Mag 7. Yeah. That's the stuff that's actually up a lot. The median stock is up a lot year to date. And that gets to what we were talking about earlier, right? If the economy is accelerating, improving, if a rising tide is going to lift all boats, it's the super tanker doesn't go up as much. Yeah. Whereas the smaller boats, the dingies or the tugboats or the smaller ships rise much faster. Yeah. And I think you're seeing that in returns. The marketplace, from an investor standpoint, you're seeing more breadth. You're no longer in this concentrated market. You have more stocks that are moving. That's actually exciting. Yeah. And would that hold true, do you think, for geography? Does that hold true globally in terms of some, you think about U.S. maybe versus the rest of the world, or that same sector? Obviously we're very concentrated in the States on the tech side. Well, so what's actually happening is that you're having a conventional cycle take place.
Yeah.
What I mean by that is that we're in the mid to late innings of a cycle, that's leadership for sectors is normally led by financials, materials, energy, things that benefit from economic growth. Early in a cycle, you want the stuff that is like where it's independent of growth. So tech is generally independent of the economy.
Yeah.
It grows pretty steadily. But as the cycle takes hold, as activity picks up, you want the sectors that are tied to that benefit from that. Right. And so we're at that part of the cycle right now. At some point, it will roll over.
Yeah.
We'll move into defensives, but we're not seeing. Let's wait for evidence of that before we get there. I think that's what you're seeing right now. And what happens is, to your question about the rest of the world, think about Canada. 66% of the Canadian index is materials, energy, financials.
Yeah.
All of those benefit from faster growth.
Yes.
Right?
And productivity.
And productivity,
things.
like Shopify, which is tech. Yeah. Like you don't shop more. Like you probably shop as much. Like Shopify doesn't see a big increment.
Yeah.
Whereas if energy prices or gold prices move higher, that just flows to the bottom line of these material companies.
Let's bring up this next chart you have here about the space race, and this is the 21st analogy to the space race. This is the AI, and I've talked to some of your colleagues too, but this is just that vast sucking sound we hear as AI just taking in all the capex, to feed what they're doing. But tell me what you're looking at.
So this is capex, right? How much these companies are spending, and we talked about the Mag 7. This is just a few of this is like Apple doesn't really spend capex. Apple doesn't make iPhones. Like Foxconn makes your
iPhones, right?
Right, exactly. It markets iPhones. It's got great ads, right? It's or Nvidia doesn't build data centers. Nvidia actually puts the chips, but the rest of the Mag 7 and Oracle, they actually build these data centers to support the growth in AI. And the large sucking sound you're hearing is the gargantuan amounts. That's not hyperbole. Amounts of capex being spent. Last year, over $400 billion in the U.S. was spent on building data centers. If we just assume that 75% of that was spent in the U.S. It's $300 billion.
It's a lot of money.
The U.S. economy is $30 trillion. That's 1% of growth.
Wow.
1% of growth of just like building these huge, data centers. And this year, whether it's Amazon or whether it's Meta or whether it's Google, they've taken up their capex numbers anywhere from like 50 to 100%. So last year the numbers were like would shock you, and this year like you are actually like you are in disbelief. Because if last year's numbers were shocking, you're up 50% more.
Yeah.
And so what's actually happening, the reason, and this ties to your question earlier, the reason these companies are lagging, right? These companies are still very profitable. They generate cash flows.
Yep.
But if all of those cash flows are being now sucked away to build these data centers, that means there's less money for repurchases, buying back shares. There's less money for dividends. In fact, for these companies, they were actually aggressively buying back shares these last few years. That's going to be on pause. They'll still pay the dividends. You'll still grow the dividends.
Yep.
But as a shareholder, I think as a shareholder, we'll wait to see what the evidence says about the long-term benefit if they earn a return on investment. But the other way to think about this is that if Amazon's going to spend $200 billion on building data centers, which it is, last year was 130, so a huge increase, why not be the company whose revenues are tied to that capex? If Amazon's spending $200 billion, that spend is someone else's revenue.
Catch that revenue.
That revenue. So I think that's much more exciting, and that's where you're seeing this broadening. Whether it's the industrial companies, or whether it's the semiconductors, or whether it's like the energy companies that are providing energy to these data centers, or the utilities.
Shovels, right?
It's like everything tied to it, right? That's 1% of GDP growth.
Yeah.
How can we, and a lot of the smaller companies, that's a big increase in their revenue. So we're much more excited about not the Mag 7, where the Mag 7's expenditures are going.
Let me ask, I've only got about a minute here, but I want to make sure I get into Halo, because we've talked about so heavy asset, low obsolescence. What's an example of that?
That's my example of that's just companies, and that's not my line. I thought it was a catchy line, right? What can't be disintermediated from all this AI? Like obviously a few of our Canadian companies, like the Thomson Reuters, or a few of the U.S. companies, even Microsoft is lagging because people have concerns, legitimate concerns about the sustainability and growth of their business model because AI.
They're high obsolescence. They worry anyway.
Yeah, exactly. But like mining.
Yeah.
Like AI is not going to disintermediate mining,
Right.
or AI isn't going to disintermediate rails,
Yeah.
which actually is broken out, or AI isn't going to disintermediate energy extraction. And like what I mean is that like Claude or ChatGPT
Yeah.
or Gemini
Yeah.
doesn't help my mining operation,
Yeah.
which is heavy asset, low obsolescence.
Yeah.
That's what I'm thinking. I think that part of the what's interesting, right? Back to my earlier thought about it's topsy-turvy, like,
Yeah.
it's bizarro world.
Yeah.
Things that you thought were like you didn't pay a lot for are now actually have the most certainty in cash flows.